Welcome, everyone. We're so glad you can join us for this on-demand webinar hosted by JFL Total Wealth Management. Today's session is part of a multi-part series called Laying Your Financial Foundation, where we will review the important fundamentals for saving and spending when you are in your 20s and 30s, and demonstrate how your financial success will depend on more than just a good income. Today, we are reviewing the different types of insurance you will need to protect yourself, your possessions, and perhaps one day a growing family. We will discuss how much insurance you need, associated costs, and options. While each of your financial situations are unique, there are certain foundations, including insurance protection, you all need in order to start the path to financial success. If you have any questions at the end of the presentation, please contact our office at 973-439-1190. We highly recommend checking our webinar library at www.jfltotalwealth.net/webinars for additional installments of Laying Your Financial Foundation series. We will be reviewing budgeting, saving for retirement, managing student loans and other debt, and how much you can expect to pay for big expenses like your first house or a baby. You can also download copies of these presentations on our website. Without further ado, let's introduce our two panelists today. Jeannie Kane has an MBA from Duke University and is a certified financial planner. She has extensive experience with analyzing and managing our private clients' portfolios and with developing comprehensive financial plans. She has a 20-year-old son and a daughter headed to college this fall. Jerry Lynch is a certified financial planner and has been an independent financial advisor for 23 years and has been working in the financial industry for more than 30. He has 3 sons, one already in college, one headed there in the fall, and another in high school.
Welcome. Thanks for taking the time to join us today.
Yeah, I appreciate you taking the time and finding out some more about how to protect yourself and your family.
We know that each of you has a personal view of what success might look like for you as you get older, have families of your own, and reach career milestones. Our goal during this series is to provide you with the background on the topics listed here, so you have the foundations for financial security at every stage of your life. Today, we're talking about insuring yourself. Jeannie's going to get us started.
Okay, so today we're going to discuss 2 different types of insurance. The first is insurance for yourself. This would be life, health, or income replacement insurance. And the second is insurance for what you own, for your stuff. So homeowners or renters insurance, auto insurance, and umbrella insurance. And this is a supplemental personal liability policy. Let's go ahead and start off by talking about life insurance. So life insurance provides a financial safety net for your family when you die. Now, prior to getting any types of insurance, you really need to determine the purpose of that insurance. Some of the most common reasons for getting life insurance are to pay off your mortgage, to pay for college for your kids, to supplement or provide income for those who are left behind. For example, if you're married and you have a young family, your spouse may decide they want to maybe cut back at work, or maybe even stop working altogether for a period of time, so they can really be there and focus on their family. Now, life insurance can give them some financial breathing room to be able to do just that. It's also used to pay off debt. Lots of folks out there have credit card debt, and insurance that can help pay off that credit card debt so your spouse isn't left maybe worse off than where you are today when you die. He or she is still going to have to pay down that credit card debt. So having insurance, again, can help as well. And it also helps cover funeral expenses. So now you know the common reasons for why people get insurance. The next step is to determine if you need it. And the question you need to ask yourself is, do people depend on me financially? If they do, then you really should be looking at some life insurance. For example, if you're married, yeah, you should consider getting life insurance. If you have kids, definitely need to get life insurance. If you're single, probably not, but if you do have, maybe you've co-signed student loans with your parents, and In that case, you would want to consider looking at life insurance because if something happens to you, your parents are still responsible to pay off that loan. And then finally, if you're financially linked to someone else, maybe you jointly own property or in a business together with someone, you'd want to get life insurance there as well. So let's go ahead and take a look at, how much do I need? So the first question you need to ask yourself is, what am I worth? And one of the ways to figure this out is through something called the human life value approach. Essentially, this looks at how much an attorney would sue for if you died during an accident. Well, a general rule of thumb would be 20 times your salary. For example, if you make $50,000 a year, you'd want to get $1 million policy. So the next question you need to ask yourself is, how much can I afford? And this really is where you need to sit down and kind of look at your budget and figure out, okay, what can I afford? What makes sense? And there are different types of policies and different, a variety of ways that they could be combined together to meet your objectives. For example, if you're married with 2 kids and you own your own home, you may want to look at maybe considering 2 different term policies. One policy would be shorter and would get you from today until when the kids are out of college. Maybe the second policy is going to be a little bit longer, which is going to help you pay off the mortgage. So let's look now at the different basic types of life insurance. And there really are 2. The first is term insurance. And this is a policy that pays a predetermined amount of money if you die within a specific period of time. Permanent insurance is the other, and that's a policy that will pay a predetermined amount of money when you die. Now, term insurance, it's called the pure insurance. If you die, the beneficiary gets the money. And they really, again, will only get the payout if they die within that term. And by term, I mean time frame. And the time frame, it generally ranges between 10 years and all the way up to 30 years. You'll want the term to match up with your objective. Ideally, your family's their need for life insurance will end around the time the term expires. It's a great option for young clients with children. It really gives you the most bang for your buck in terms of coverage. And in many cases, term insurance can convert into permanent policy as well. Now, for permanent insurance, this offers lifetime protection, but it's more expensive because of its features. In general, the premiums they're going to look to be maybe 6 to 10 times more than you'd pay for a term policy. There are a couple different types. The first is whole life, and this offers more guarantees with fixed premiums. The fixed premium, again, this is going to be the same premium that you're paying today as you would when you are 75 years old. It's going to stay the same for the rest of your life. It also has some guaranteed growth built in, and it tends to be one of the more expensive options. Now, for universal life, this type of policy gives more flexibility, and it's a little less expensive. And the flexibility allows you to adjust your premiums and also coverage amounts over a period of time. Now, one of the benefits for permanent insurance is that they all offer cash value. And cash value is the value of your premiums and the growth that builds over time. And the key benefit with this is that you're allowed to borrow against it. In fact, Jerry bought the JFL building by borrowing against his whole life policy. One of the questions we get asked a lot is, what's the best type of policy? Well, each of them has their pros and cons. And if you speak with us at JFL or another insurance provider, we can provide a plan based on what you're trying to achieve. Let's talk a little bit more about coverage and cost. So let me start first with what you should expect when you apply for insurance. You're going to obviously fill out an application. They're going to pull doctor's records for 5 or more years, at least. They'll do a medical exam. They'll have your blood drawn. And then the underwriters are going to take that information, do an analysis, and determine what sort of risk you are. Well, what determines whether you're a good risk or bad risk? There's several factors. Your lifestyle being one of them. Do you drink or not drink? Do you exercise? Your age will also come into play. All things being equal, insurance is less expensive when you're younger. Your health tends to be better too. Now, if you wait to get insurance, you'll end up paying more, but you'll also run the risk of maybe not even being insurable. If you have a pre-existing condition, such as high blood pressure, you'll be higher risk. For smokers out there, your premiums are going to be 2 to 3 times more than a non-smoker. Now, your occupation also plays a role. Who's most likely to die on the job? Well, you've got your accountant versus your skydiving instructor. It's a pretty easy answer. For coverage amount, again, the more coverage you have, that's going to be more expensive as well. Now, if you walk into our office and tell us that, I need insurance, or, hey, I just came from the doctor and the doctor says I really should look into getting life insurance, you probably won't qualify it, or if you do, it's going to be really expensive. The time to get insurance is when you're young and healthy, not when you're sick and need it. Let's give you a more specific example into the costs right now. So looking at this chart, we're comparing two different types of policies here. There's the whole life, which again, remember that's a permanent policy, versus a 30-year term policy. The permanent policy is more expensive from a premium standpoint. It's going to be at least, on average, going to be at least 10 times more expensive. And why is that? Well, that's because you are guaranteed $1 million at any point in your life. When you die, automatically get the $1 million. Now, for a term policy, you won't be guaranteed that payout because you have to die within that term period. If you die outside of the term, there's no payout. And there are a whole range of options between term as well as whole. Now, guys, you can expect to pay between 15 and 30% more than women, and that's because men have a lower life expectancy. And I mentioned earlier, the older you get, it gets more expensive. Let's go into a more specific example here. If you compare the cost of the 30-year term policy for a 30-year-old versus a 40-year-old woman, the premium, that increases from $525 up to $893. That 10-year time frame, that increased your premium by 70%. Now, there are a couple things that aren't really captured here on the chart. The longer the term, it's going to be more expensive. The higher the coverage, again, it's going to be more expensive. Let's go ahead now and talk about some health insurance. Now, there are two ways really to get your health insurance. You get it through your employer or you get it through the marketplace. And regardless of the type of plan that you have, policies, they all generally work the same way. There's the premium, and that's how much you pay just to have the health insurance. You have a deductible. This is how much you have to pay before the insurance company starts paying benefits. You have your copay, and that's your part of what you have to pay when you go to the doctor. And then you've got your out-of-pocket limit. And that's that maximum that you're going to have to pay every year. With an employer-sponsored plan, it's surprising that only about half of all Americans have a plan through work. And the younger you are, the less likely you are to have it. Through the work plan, you may also have access to an account that allows you to pay for your medical expenses pre-tax. There are two examples of that. There's the flexible spending account, or the FSA. This is called like a use it or lose it plan. And that's when you kind of have to do some budgeting to kind of make sure that if you don't spend all that money during the year, you lose it, it goes away. For the health savings account, you use it today, and you can also leave it in the account, and it can be used as sort of an investment that'll grow tax deferred for the rest of your life. Now, the FSA and the HSAs, they can help you save up to a third on healthcare-related items like healthcare copays or contact lenses. Kind of a nice perk. Now, the second option of where you can get insurance is through the marketplace. This is kind of the Affordable Care Act, Obamacare, kind of created these plans for people who didn't have access to employer-sponsored plans. You can get them through healthcare.gov, most states. There's an enrollment period. It's generally just one time during the year. Although, if you have a qualifying event where maybe you've had a baby or you lose a job, those types of events you can still apply and be eligible to get marketplace insurance. There are 4 different types of plans. They kind of vary with benefits, et cetera. You want to look in to find the one that would be the right one for you. And the nice thing about these plans is that 100% of preventative care is covered. Now, if you have the option between an employer-based plan or, maybe, looking at the exchange, in general, the employer-based plans, they offer better benefits and they're going to be less expensive than plans on the exchange. Now, one of the things we see sometimes is with people who are in their 20s and 30s, maybe think they don't need health insurance. They're young, healthy, and it can be pretty expensive. But all it takes is one car accident or unexpected illness, and you're in trouble. You get hit by a bus and you're not covered, you'll be paying the highest possible rate for care, and you're going to be paying that out of your hard-earned savings. So let me share a scary statistic with you here. 2 out of every 3 bankruptcies are due to medical expenses, not due to mismanagement of your money, but due to paying medical bills. So it's a really good thing to have health insurance. Next one we're going to talk about is income replacement insurance. And here's another scary statistic. 1 out of every 4 20-year-olds will be disabled for 90 or more days before they retire. So how are you going to pay the bills during that time? Well, that's where income replacement insurance comes in. It offers covers a wide range of illnesses and injuries, and look for it to cover between 60 and 70% of your salary. And who needs it? Well, the simple answer is everyone. If you don't have income coming in, you're really going to draw down on your savings pretty quickly. And it's especially important for you to have it if you're the primary breadwinner in your family, or if you don't have a plan through work. So there are a couple of different types of coverage, and the types of coverage that you need, be looking at short-term and then long-term. Now, short-term generally is between 3 and 6 months, and many employers offer this type as part of a benefit package. And we generally don't recommend that you buy this on your own because it's expensive, and you really should have an emergency fund with enough in it to cover 3 to 6 months of your expenses. Now, for the long-term coverage, this would cover you for an extended period of time, looking at 5 or more years. Now, I've talked about the types of insurance that impact you. Jerry's now going to talk about the types of insurance that are for your property and for your protection, in your possessions. Excuse me, Jerry.
Thanks, Jeannie. Just in the mode of full disclosure, we are not licensed for property and casualty. That's the areas that we're going to be taking a look at right now. We have firms that we work with on the outside that can help review this, but I think it's something that we do look at on a regular basis for our clients. And I want to kind of go through a couple different things here today, specifically dealing with your homeowner's insurance. There's really 4 components of what your homeowner's insurance is going to do for you. The first thing that it's going to do is going to protect your home, meaning that if your house is burned down to the ground, there's a cost associated to rebuilding that, and basically the insurance company will come in and give you a check to basically build your home back up. It's also possible that if your home burns down, that there's new zoning codes that may require that you build your home differently from the first time that you had it set up. So that needs to be taken into consideration as well too. Every few years, you need to make sure that your homeowner's policy is keeping up with the cost of living, because construction materials have gone up substantially over the past few years. There's a ratio that you have to understand called the 80% rule. And let's assume, for argument's sake, you had insurance on your home for $100,000, or your home was worth $100,000, and you had insurance that was only on $50,000 in your home. If you have a $10,000 claim, you're below the $50,000 maximum they have, but they're not going to give you the $10,000. They're going to give you a percentage of that because your home was not fully insured. So every few years, you need to go back to your agent. You need to make sure that your home is insured for a reasonable amount based on the square footage, the area, the cost of rebuilding, and so forth. That's very, very important. The second thing is that, all right, let's assume that the insurance company fixes your home and your home is rebuilt and everything is fine. What about your stuff? You have a bunch of stuff that's in your home. You have your clothes, you have your furniture, you have stereo equipment, electronics, all different types of things. And this part of it will give you a replacement for those things that you're losing due to that, either a theft or a fire. So what I suggest to people is that on a systematic basis, let's say once a year, walk through your home with a phone. Just basically videotape everything. I'm going into my living room. This is my living room. Here's my bedroom. Here's all the stuff that I have. So you have documentation that if there is a problem, you could go to the insurance company and say, here's a copy of everything that we had in our home. If you don't have that, it's very reasonable that you're not going to remember a thing you have, and you're going to get less of a reimbursement that you should. And it's important that if you're paying for this coverage, you get the money's worth. The other thing that it covers on homeowners insurance is liability. So let's assume I'm having people over at a picnic and somebody slips and falls and hits their head. They need to go to a hospital. They need some medical stuff. There's a liability component that's associated with it. Usually it's about $1 million. I'm sorry, $100,000, but it may be substantially higher. Some dog breeds, for example, that are considered aggressive, either A, will not be covered. They said we will not cover a Rottweiler or a Pit Bull or something that has the potential to bite somebody and cause damage, or they may rate you a little bit more expensively because of those types of dogs. If you have a trampoline, it is very reasonable that the insurance company may come back and say, hey, listen, unless you get rid of that trampoline, we're not going to cover you. So they're going to want to make sure that if there's any outstanding issues, they're going to address them in advance, because they don't want to be on the hook for somebody bouncing on a trampoline, falling off, and really getting seriously hurt. But there's a liability associated with that. And again, the levels can vary. And the last thing is, let's assume your house burns down. Where do you stay? Where do you go? What do you do? There's a cost of living that they will give you that basically allows you to have a hotel for a period of time while the construction is being redone. And that could take up some time. Usually that's a ratio of your coverage, maybe 20 to 30%, because it can take quite a few months from the time that your claim is filed until your home is actually redone, where you could get back in there. So I think that's also very important. Now, there's also, if you don't own your home, there's renter's insurance. And renter's insurance, basically, so let's assume I own the home that you live in and the home burns down. I have the insurance for me that basically replaces the walls, the building, the structure. It replaces the stove, all the components of the home. But it doesn't replace any of your stuff. I don't have an insurable interest in your stuff, so it will not cover anything of your personal possessions. So renter's insurance would basically provide coverage for you in a couple different areas. It would take care of your personal property, your TV, your clothes, everything that was included in that home would also be included here. A level of liability coverage. So again, if you have people over, somebody slips and falls, they get hurt, whatever the case may be, you have a level of coverage, and usually the landlord would also have a level of coverage as well too. And then additional living expenses. So if you are put out of your home for a period of time due to a fire or some kind of condemnation of the building, you would have the ability to basically have your rent paid for a period of time, because you might still have to pay the rent at both places. This is something where if you have a decent amount of stuff, you should consider having this coverage, because it is pretty important, especially as you get more and more stuff. Now, another important thing to take a look at is auto insurance. And many of us drive, and the potential, the more you drive, the potential is that there's a greater chance that you're going to have an accident. And an accident means that a couple of different things could happen. Number one is materials could get damaged. My car could get damaged. Your car could get damaged, but people could get hurt. So there's a couple of components that you need to understand. The first is the deductible. And the deductible is really how much are you responsible for before the insurance company kicks in. It could be $250, $500, $1,000. Maybe some companies have variations between that. Generally, the higher the deductible, the lower the premium is going to be. There's usually a deductible on the collision, which is me hitting you with my car, and comprehensive, which is really if my car gets hit by a tree or basically gets stolen. The premium is going to be determined by a number of different factors. Number one, what is the deductible? How much do you have to pay before they kick in? It's also based on your driving history. If you have a history of speeding tickets and accidents and things like that, you're considered a higher risk. They may not even insure you. And also sometimes even your credit scores will have an impact on what your premiums are. And also the level of coverage that you have. So you could have liability limits up to 500,000, $1 million, whatever the case may be. So the bigger the coverage, the more comprehensive the coverage, the more expensive the policy is going to be. And New Jersey is known as a no-fault state. What it means is that if I'm in an accident, it doesn't mean that I only get paid if I'm not at fault. My insurance company is going to pay me back no matter what. Now, they may go back to the other insurance company and fight for that money, but the bottom line is that my insurance company is going to deal with me direct. There are a couple other states that have it where you have to prove it, but the bottom line is if I have no fault insurance, I have an accident, the accident is taken care of. If I have collision on my car, then basically they will pay to reimburse the cost for fixing it up. Now, also with that, there's a couple different components of that coverage. Number one is the liability that's associated with me hitting somebody else or an accident. So what that would do is, let's assume that I'm driving and I hit another car, or I hit a telephone pole, or I actually run into a building. All right, there's a cost associated with making everything right as it was before I hit it. That liability portion will basically allow the insurance company to write a check and make whoever I hit whole. Your liability limits, it must be either might be 250,000, might go up to $500,000 per accident. It might be, usually it's per person and then per accident entirely. So if I hit 2 cars and I have $250,000 of liability per person, 500,000 would be the maximum that would be allowed. Comprehensive deals with a couple different things. Number one is if a tree falls on my car, that would come under the comprehensive part of the program. If my car is stolen, it would be covering under the comprehensive. These are things that are related to me not driving the car at that moment in time, and where I have some kind of economic loss. Most of the time, the cost of this coverage is relatively inexpensive because the odds of a tree falling on my home are very low. The odds of my car getting stolen are pretty low. The odds of me getting into a car accident if I drive a lot on a regular basis are substantially higher. And then finally, you have the collision coverage. And the collision covers the cost of your car, of my car, personal car, if I'm in an accident. Now, again, if I'm in a no-fault state, it doesn't matter if somebody hit me or I hit them. My insurance company is going to reimburse me for whatever cost that's associated with that. But this is something that's really important. And even if you rent cars, you might have the ability to get a phantom auto policy so that when you rent cars, you have some level of coverage. Okay. Now, one of the most important coverages that I think that people should talk about, but most people don't have, is something called an umbrella policy. If you think about insurance companies, what do they want to see? Is they want to see high premiums and low liability limits. They want to make sure that the income that they're receiving is as high as it physically can be, and that their potential exposure is as low as it could potentially be. I want the opposite. I want the lowest premiums and I want the highest liability available to me, so that if I have a major problem, I'm protecting myself against catastrophic losses. An umbrella policy, the way I describe it, it's like having a teacup and a saucer. The teacup is either your home or your auto coverage. And once it runs out and you get to a point where it runs out of coverage, the saucer is below that, and that's the umbrella policy. And it picks up anything that pours out of that cup and is excess liability coverage. And these could be either 1 million, 5 million, sometimes they even go higher than that. Now, when I was looking at insurance coverages for umbrella, what I did is I talked to my agent. I asked him, how much is $1 million worth of coverage? And he said it was $325. And I said, just out of curiosity, what is $5 million of coverage? He said $427. And I looked at him, I'm like, why wouldn't anybody do that? Now, the thing is, I'm relatively cheap. My wife says I'm incredibly cheap. I didn't want to pay that $427. So what I did is I increased the liability, the deductible on my home and my auto from $250 to $1,000, which reduced the premium. And I used that savings to basically pay for the cost of the umbrella policy. So what it did there is if I have a claim, a big claim, I'll file it. If I have a small claim because I have $1,000 deductible, I'm not going to file it. And that means that I'm more likely not to get dropped from my insurance company because I'm not going to file many claims unless they're absolutely necessary. The general rule is if you file 2 or more claims in a 3-year period of time, it is very reasonable that you're going to get dropped from coverage. They don't want people saying, I paid $2,000 in insurance, they should pay my $2,000 bill. It doesn't work like that. The purpose of insurance is that most people should not be benefiting from it. It's pooling resources and sharing risk. So if you're thinking that if I pay $2,000, I should get $2,000 back, it doesn't work like that. Make sure that you have a high enough deductible that it applies. So again, this also applies if you think about you're going to have kids pretty soon coming out and they're going to start driving. If you have a 17-year-old and you go to an insurance company and you say, could I get an umbrella policy? The response is almost always going to be absolutely not. Nobody in their right mind is going to give you $1 million, $2 million, $3 million of coverage when you have a brand new driver in your house. If you have it before your child becomes available for their license, it is reasonable that you'll get it, and it will continue through your children getting their license and so forth. And they're relatively inexpensive. So I would always advise people to take a look at this and see who basically should, if you can afford it. Now, anybody should have this if either A, you have a high income, or B, you have a lot of assets, or you drive a lot. It simply puts you at risk more. If you drive a lot, it is reasonable that you will have more accidents and somebody may get hurt more than somebody who doesn't drive on a regular basis. If you have more money and more assets, you have more to risk if you get sued. If you have $500,000 of liability coverage on your car and you get sued for $2 million, that's $1.5 million is on you and all your personal assets are at risk. So make sure that you have a high enough level of liability where nobody's going to come and take your stuff. That's really important. Now, again, I think there's a couple of things when you think about insurance that you should remember. Determine your threshold for deductibles. That is what your responsibility is before the insurance company kicks in. The higher the deductible, the lower the premium, and the less likely you are to file a claim. If you are having a high deductible, make sure that you have money set aside where if you do have a claim, you have the cash available to pay that money necessary to have the deductible paid for the insurance company to pick up the rest of the claim. Think twice about filing a claim. You do not want to think about this as a piggy bank. If you have a major problem, file a claim. If you have a $500 accident on your car, basically a little tiny ding is $500, and you have a $200 deductible, and you file a claim, that counts as a claim. That's one claim. You're getting $250 back from the insurance company. You have another one in the next 2 or 3 years, it's very reasonable you're going to get dropped. The reason why I have a $1,000 deductible is A, it's cheaper, and B, I'm not going to file a claim unless it's a big claim. If it's something that's $5,000, $10,000, I'll definitely file it. And the third thing is review your coverage every few years. You know, after Sandy, everybody was around filing claims with their insurance company, and they had no clue what they were covered for. You know, they would file it and kind of sit here and hope that everything went well. Insurance shouldn't be like that. You should know that I'm covered for this and I'm not covered for this. And these are the areas that I potentially have some level of a gap. Know what your gap is and say either I'm willing to deal with this because I don't think that's much of a risk, or I might want to get some additional coverage in that area and just make sure that I'm doing it right. So if you look at the best practices for people, you know, and again, in dealing with insurance, and nobody likes talking about insurance, I understand that, is again, there are 6 policies that I think everybody should really seriously take a look at. Number 1, life insurance, health insurance, disability, you know, and then you have your auto, homeowners, and excess liability umbrella policies. These are incredibly important coverages. With life insurance, the amount of life insurance that most people have is insane. You know, again, you need to make sure if anything happens to your family, that your family is fine. That's part of being an adult. All right. So if if anything happens to you, your family should be able to do exactly the same things than if you were here. That's the purpose of any insurance policy. So take a look at these things, and the cost of some of these coverages are incredibly low. And this is also part of an overall financial plan. And that's really just a couple of things. Live below your means. The people who we meet that are clients of ours that are financially successful, it's not because they made $1 million a year for 30 years. It's because they consistently lived at a reasonable level and saved through all different types of market conditions. Number 2, anytime you get a pay increase or you pay off a loan, automatically take that money and start investing that on a systematic basis. Now, again, let's assume I get a $10,000 raise, all right? Doesn't mean I have to save $10,000, but maybe half of that should automatically go into that investment account on a systematic basis, and half of that should go back to the family and have some fun. You got to have some fun with this stuff. However, again, if you consistently increase your cost of living over a period of time, you're never going to be able to save. Automate. I don't write a check for anything. Automatically, once a month, money comes out of my bank account and goes into my investment account. As soon as it hits the investment account, it automatically gets invested. Automatically, money goes into my permanent life insurance. Automatically, money goes to pay my mortgage on any of the rental properties that we have. I don't do anything except take a step back every once in a while and make sure it's going in the right direction. Finally, get some good estate planning documents. If you have kids over the age of 18, or yourself, if you're younger, you need to have wills. You need to have power of attorney. And if you're married, you need to have medical power of attorney. So if your spouse needs care, you could authorize it. Just because you're married doesn't mean that you could authorize care for your spouse. Their information is confidential. And finally, you're at probably the lowest tax bracket of your life. Take advantage of that. Consider doing a Roth, either in your 401k if it's an option, or within an IRA. Over a period of time, you'll be very thankful that you're doing this on a systematic basis. Now, again, I can't stress this enough. We're here for you. I think that there are many resources that we have. If we don't know the right answer, we can point you in the right direction and make sure you get to those people. Insurance is really one of the foundations of any financial plan, making sure that people can't take your stuff and that no matter what happens, you and your family are going to be fine. So it's something that I think that everybody should look at. If there's anything we could do to help you, please feel free to reach out and give us a call.
All right, thanks, Jeannie and Jerry, for that great advice about protecting yourself and your possessions with insurance. If you have any questions or would like to speak with Jeannie or Jerry about your personal financial situation, please contact our office. And be sure to visit our website, where you can view other key topics for laying your financial foundation. Thanks, everyone, for joining us.